So this is this is part of a series of outreach events for the International Financial Reporting for Non-Profit Organisations consultation paper. Today's webinar is about non-exchange revenue and inventory held for distribution. These are issues papers 3 and 6 in part 2 of the consultation paper. And the objective of today's seminar is to familiarise you with the content of these papers and hopefully give you confidence to respond to the consultation paper. So let me move us on to our next slide. Just apologies. The agenda for today will look at what we understand to be the issues facing NPOs and the financial reporting that gives rise to. We'll also look at the different approaches outlined in the consultation for how we could take forward these issues. We'll finish each part on consultation questions and how you might be able to respond to those consultations. We have some polls to get your input throughout the webinar. We'll also discuss the results of the polls, as well as give you the opportunities to ask any questions at various points during the webinar. But please feel free to add your questions at any time through the chat. Any questions or comments, please use that facility. We expect the webinar to run about 2.5 hours, maybe slightly more, but that will be dependent on the number of questions that you have. We will definitely not be running beyond 3 hours, and if we haven't answered all of your questions in that time, we will follow up after today's session. So we are proposing 10 topics for inclusion in the first set of guidance. These 10 topics cover matters relating to the reporting entity, to revenue, to expenses, aspects of the balance sheet, and matters relating to the presentation, content and scope of financial statements. We won't be able to cover all NPO specific issues in the first set of guidance, so it's important that we include the ones that have the highest priority for the sector. The overview to part 2 looks at all of the issues that have been identified to date and also looks at how we prioritise these. And in the overview, we're seeking feedback on the entire list of issues and their prioritisation to make sure that we're focusing on the right things. In examining each issue, we are focused on the project guidance objectives that underpin the quality, credibility, transparency and comparability of financial statements. The objectives are also focused on meeting the needs of users of financial statements, but in so doing, balancing these against the needs of preparers. So today, as I said, we'll be looking at non-exchange revenue, which is issue paper 3 in the consultation paper, and inventory held for use or distribution, which is issue paper 6 in the consultation paper. Knowing when and how to recognise revenue such as grants, donations, gifts in kind and service in kind has been a consistent issue raised in our outreach discussions. And we are calling revenue from these sources non-exchange revenue. And we're calling it this because in these transactions, the individual or organisation providing cash or resources does not receive something of approximately equal financial value directly in exchange for the resources provided. The cash and resources are provided for the benefit of other individuals or organisations, not the contributor themselves. So they haven't had an exchange, and that's why we're calling it non-exchange. In thinking about this topic, organisations need to know when to record revenue, how to measure it, and what information they should provide. I should say we won't be covering revenue from commercial type arrangements, such as providing services to third parties for a fee or selling goods. And whilst there may be some issues associated with these types of transactions, they haven't been identified as NPO specific issues. As we identified earlier, inventory can be donated rather than just purchased. That could be the resource that's provided by a contributor. And this inventory can be held for use by the NPO themselves or for onward distribution to service users. The questions we hear are similar to those raised in thinking about revenue, about what to recognise, but also extends to how inventory is impaired. So those are an introductions to the topic, but I wanted to speak a bit more specifically now about the issues. And rather than hearing me speak throughout, to introduce this topic, I'll be sharing with you some short videos that reflect the experiences of members of the non-profit community around the world. These videos will provide perspectives on today's topics and describe day-to-day experiences. And so to kick us off, I spoke to Sam Museke, my colleague, recently about what she has been hearing and the feedback that Sam has been receiving from stakeholders. So here's the short video. So Sam, you've been involved in country awareness meetings and lots of other outreach meetings during this consultation paper. And I know that you've had in-depth discussions with members of our advisory and reference groups. It would be really good to hear some examples that you've heard of from around the world that bring this topic to life and embed it in reality, that sort of move away from the theoretical questions to the practical and the situations that people actually experience. I'd be really interested to hear some examples of the contributions that you've heard. And perhaps we could start with cash contributions like grants and donations.
Sure. So, well, obviously, in addition to general donations, there's so many different kinds of grants with different kinds of restrictions and conditions. And I think that's a particularly interesting area. I can give an example of a grant funded by a bilateral donor to fund vocational training institutes in post-war northern Uganda. And there was a restriction within each major budget line. We had flexibility, but then between the major budget lines, there was only a 10% flexibility. And then remember, if we wanted to do anything different on equipment, that needed prior approval, and overheads, we also had no flexibility. It was just a percentage of direct costs. So there was that degree. And I think, you know, with restrictions, we can have almost anything from, you know, spend this on anything as long as it's in the Philippines, right down to, you know, line by line requirements. I think there can be quite a range of restrictions that we see in practice. I heard of another really interesting example in India. So there's some private charitable hospitals, and then as a condition for receiving charitable status, they have to keep 10 to 20% of their beds available for people who can't afford to pay. And they sometimes get government subsidy to help cover those costs. So that was an interesting case as well. And then another one I thought really good for in the education sector. This is also in India, of somebody giving a bursary to a university specifically to fund girls studying engineering. So again, quite a nice degree of restriction there.
Sam, thanks for that. I mean, there's some really interesting examples that you gave us there and some really different situations that people are experiencing. And I think that's just the kind of thing that helps bring it to life. But what about donations of assets, you know, rather than money, something else that has been given, you know, use of an asset or an asset in kind? Have you got some examples of those as well?
Absolutely. And I think this is a particularly knotty area for people in our sector, isn't it? So I heard of a great example of a non-profit organization that provides affordable housing for poorer members of society. And they received a donation from a philanthropic fund specifically for the construction of housing development, a social purpose asset, if you like, which took nearly 2 years to build. So I thought that was a very interesting example with some good accounting issues in there. And then I came across an interesting example in East Africa of an NPO that was purchasing 2 identical vehicles for a malaria program. And one of the vehicles was funded by a donor that was quite relaxed in their approach. They needed to see that the organization had purchased the vehicle, but after that, they just trusted them to use it as needed. And then the second vehicle was funded by a bilateral donor that had quite a few rules about asset use. So first of all, the grant agreement said that the vehicle had to be used for this malaria program over the 3-year grant period. And then that at the end of the grant period, the vehicle would be returned to the donor. So that brought up some really interesting questions. So even though the logbooks were in the name of the organization, with respect to the second vehicle, was it substantively theirs? Did they own it, or were they just given the right to use it for that time, even though the vehicles are identical and for the same project? So that was quite an interesting one. Then another one I came across again recently, it's a non-profit enterprise in America that manufactures nutrition sachets for malnourished children, and they're then sold on to aid and relief agencies to use in emergency situations. So this NPO, they received a donation of highly discounted multi-year software license from a USA-based software company that provides, ERP and CRM solutions. And this NPO, they use it to manage all their accounting and budgeting, reporting, logistics, and database needs. So it really helps their work. They probably couldn't afford it if they had to pay full price, but they received that as a sort of donation in kind, asset in kind. And then the final example that has come from one of our advisory group members, I find particularly interesting, is a donation in kind to a non-profit museum in Japan. This lovely museum celebrates beauty and mental health and the environment with a stunning collection of shells and pebbles. And so these are donated by individuals. And of course, it's impossible to ascribe any kind of meaningful value because they are invaluable.
Yeah, really interesting. And you've covered a range of different types of assets that can be donated to NPOs, all with different challenges, I think, attached to them. So what about examples of volunteers and other types of services in kind? Have people shared examples of those with you as you've talked to people about the consultation paper?
Absolutely. And volunteerism is such a wonderful and central feature of this sector, isn't it? One example is from an organization in the Caribbean, enabling entrepreneurs to build sustainable livelihoods. And they have volunteers that include mentors who advise and encourage the young people. So that's a good example. There's an organization in Tanzania where community members contributed their muscle as unskilled labor on the construction site of a village health facility. And what the organization did there is they valued that time and they were able to have it considered as match funding from a donor who would only contribute a maximum of 80% of the project costs. So that was also an interesting example. I myself have a friend who volunteers as a trained grief counselor for an organization that supports people who've lost a child. And perhaps some of the people who are attending this webinar will have volunteered their time in community event organized by an environmental NPO to, I don't know, pick up litter or plant trees or something like that. So it's quite common. So then in terms of other types of services in kind, apart from volunteers, there's an organization that I know about that reintegrates children who've ended up in orphanages to go back and live with their families. Now, most of the head office staff work from home, but they needed office space just once a week for meetings. And one of their board members had this lovely riverfront office space, and he donated that space to them for free for those meetings. Of course, it was much nicer than they needed or what they could afford, but they were very happy to accept that, and they have used that. Then another example that comes to mind is a non-profit school that was building a new campus. And one of the parents had a connection to a tractor company, and they managed to get the donation of earth moving equipment for a month to help with that construction. I can imagine that many NPOs among our listeners here will know of organizations that have received pro bono professional services like accounting or legal services from generous firms.
Great, thank you, Sam. Some fantastic examples there.
So Karen, I did also want to share this clip from Jobra Mulumba, CPA from audit firm Saka & Co in Uganda. about his client who's using the deferral method for income conditions, for income recognition, but with conditions. So I'll show you this.
So we have a client which is an international NGO, but they were required to recruit and rehabilitate 200 girls in northern Uganda. So the revenue had to be apportioned against the number of girls who were being recruited and rehabilitated. So that apportionment is what we call targets being met against revenue recognition. But the dangers are in identifying the milestones against which such money should be recognized, and also where these targets are incomplete or the qualitative aspects relating to them. So I hope that this project will help us in solving all these problems. Thank you very much.
I hope that worked. And then I'd also like to recognize and acknowledge, let me see, 3 gentlemen who shared their stories and experiences with me, took their time and effort to record videos and have interviews. Erastus Omolo, FCA from Crow LLP in Kenya, Homia Madan from HFK Madan in India, and Dr. Muhammad Abdul Hay from Shafak organization in Turkey. And I really appreciate their time and efforts in sharing their experiences. Thanks.
We haven't covered inventory as promised, and we haven't forgotten that either. And we're now going to play a short video from Phil McMinn-Mitchell, who is a member of our practitioner advisory group.
I've worked with charitable health centres as part of the national health response in Uganda, and for emergency relief organisations working in several countries for different donors. A practical challenge for both is how to present the value of donated inventory. As a primary healthcare clinic, our services include distributing free-to-client products, such as mosquito nets or subsidised treatments for patients with HIV. After the patient's well-being, our main admin concern is the physical control of the commodities, as well as knowing when to reorder and which source to report to with the information on patients reached. For the humanitarian organisation, donations in kind were needed to address lack of suitable items in the market. This was often because a natural disaster had disrupted supply chains, or demand exceeded stocks and prices rose. We therefore needed a valuation basis that is fair and easy to explain to staff and funders. As well as reporting to donors and to suppliers of the subsidised health products, we need to report to the local regulators or charity board, and so the value of stock at the period end needs a basis for reporting in financial terms. The fair value of donated items is a challenge, as sometimes even the entity providing the items might not have that information. The effect of bulk purchasing by the donor, for example the mosquito nets, means comparison to local retail pricing is unrealistic. Similarly, the current replacement cost of a bucket or plastic for shelter after a storm will be rising each day, which is why donations in kind are needed in the first place. When valuing donated inventory, both for the charitable health centre and the emergency response NPO, we need to consider what cost information is available from the supplier. With items that are provided free of charge to the client or at a subsidised cost, it will be helpful to have guidance for a valuation basis that is meaningful and consistent and can be described in our accounting policies.
And I'd like to extend my thanks to all of those who provided examples or participated in the videos, which I think have helped to highlight the different facets to the issues that non-profit organisations face. You know, these are real examples of the issues that are outlined in section 1 of both issue paper 3 on non-exchange revenue and issue paper 6 on inventory held for use or distribution, as set out in the consultation paper. So, you know, there clearly is a range of transactions and considerations attached to these kinds of things that create a number of issues for NPOs. And we're interested to know whether these issues resonate with you, the things that you've just heard of, things that you're encountering. And, you know, that clearly was not an exhaustive list, but it's important that we're all starting from a similar place in terms of the scope of the issues. What I wanted to do next is just kind of do a bit of a check-in with you. So you've seen the videos, you've seen some of the points that have been raised, and and what others on this webinar are feeling about the issues. So we would just like to just run a short Q&A really, just to pick up any questions, comments, observations, because we have heard in our outreach that valuing donated inventory can be really challenging. And also there were lots of challenges shared on non-exchange revenue, including the timing issues that we just talked about there. And we've also heard about challenges for smaller entities. So interested in knowing whether these are the issues for you as well, and whether anyone can kind of share some thoughts on that. We've just put a couple of questions on there about have you got any questions on what you've heard so far, and was there anything in the poll responses that surprised you? We've also put some questions in there for you to kind of take away, because we'll give you the slide deck at the end to kind of think about in terms of your consultation response. Point come in here saying that that voluntary contribution means fundraising donation and not a restricted grant. So terminology is really important. I think that's absolutely right, and I think that's one of the things that we're going to need to really clearly set out as we go forward. One of the points that has come up to us so far is that also terminology is different in different jurisdictions, so terms mean different things in different places, and as part of an international project, that's something that we're going to need to overcome. So thank you for making that point, because that's a really important one. Another point in the chat about timing of revenue recognition and matching against expenses, including capital grants. Yeah, absolutely, and I think that's something that we will need to kind of work through. For those that follow the accounting standards and they're developing the matching concept is not one that sits as a key concept now as part of accounts, and so revenue and expense recognition follow different paths, but clearly that does create issues and things that we need to follow up on. So, in this section, looking at financial reporting challenges, we want to kind of look at what exists for voluntary contributions, and that includes for cash, assets, time, grants, or any other revenue that it can be received by an NPO that's not the sale of a good or service. So that's what we're trying to capture in here. And we're also looking at the financial reporting challenges where the contribution received is an inventory item rather than anything else. So just looking at these financial reporting challenges, we're highlighting recognition, measurement, and disclosure as the most significant financial reporting issues in both of these areas. And just to kind of take a step at the beginning, according to the International Accounting Standards Board framework for financial reporting, income is at its core an increase in assets, and these assets need to be controlled by an entity. So to recognize revenue, we are concerned with issues like when revenues are controlled by an NPO. Clearly, recognition issues go beyond that, including from a timing perspective, as we've just talked about, and we'll come back to, and when, in terms of when they should be included in the financial statements. We're also concerned with whether a reliable measurement can be determined so that it's possible to recognize valuations for donations, including inventory. And clearly in the poll, valuing inventory was an important issue. So in terms of measurement, we're concerned with about how to determine the value of resources that have been provided, particularly non-cash resources. And in terms of disclosure, we're interested in whether there's any information that should be disclosed in the financial statements that will make it easier for readers to understand the information in the financial statements. So in this regard, recognition, measurement, and disclosure lie at the heart of the challenges that we're setting out in the consultation paper. And we'll now look at each of those in turn. Okay, so let's move us on. Okay, next slide. So the first issue that we want to consider is whether the NPO controls the resources that have been provided to it. And you might wonder why we're starting with control. And the reason for this is that if an NPO does not control an asset, it has to worry a lot less about whether it should recognize it or measure it, because it's not its asset. So this is absolutely the first consideration. And the first step will be for NPOs to determine if they control the cash or resources provided. This might seem straightforward, particularly for cash contributions, but if a contributor provides an asset for an NPO to use for a project, but requires it to be returned at some point, is that a donation of an asset that the NPO controls, a gift in kind, or is it the right to use the asset for a period, a service in kind, where the NPO controls the asset only for the period that it uses it? There are also issues specifically related to services in kind. NPOs can recognise revenue in respect of the services in kind where there is a past event and an NPO expects to get a future benefit from those services as part of furthering its objectives. This is in line with the definition of assets in the ISB's conceptual framework. And it applies even if that future benefit is used straight away, like professional services. For example, if an individual provides accountancy services to review an NPO's accounts, this is likely to be under the control of the NPO if they are scoping the work to be done and have records to support this. But if a group of individuals voluntarily decide to hold, say, a coffee morning to raise funds, the time of the people that are providing a service in kind by organising the event is not likely to be under the direction of the NPO and is less likely to be under the control of the NPO, and so less likely to be recorded. I think this sounds right. The less likely the NPO to have control, the less likely it is to have records. So NPOs need to have records and processes to demonstrate that they have control over the delivery of the services in kind or the outputs of the service in kind to be able to record them. The question of control also arises if a contribution is made through a pledge, particularly the pledge is not binding on the person who's giving it. In other words, the donor could change its mind from the point in time that the pledge is made. In this situation, the NPO is not likely to control the asset. Control will pass at a later point in time, most likely when the asset has been received. And the NPO will need to have appropriate monitoring processes as it will have an impact when the revenue can be recognised. This also applies to bequests, but we are not looking at that as part of this topic, and that will be considered separately at a later state of this overall project. So you can see that in situations like these, ascertaining control over resources might be challenging. And for some types of resource, like services in kind, the NPO might need additional systems to ascertain the amount of resource that it is controlling. With NPOs needing to be certain that they have control over the resources provided to them to be recognised, additional records and systems may come at a disproportionate cost. So having determined whether an NPO controls an asset, it will then need to ascertain if it can obtain a reliable measurement of the value of the resources that have been donated or contributed. If it's cash, that might be more straightforward, but less so if it's a contribution of an asset or a service. An NPO will not be able to recognise any revenue on receiving the donated item if it can't obtain a reliable measurement for it. And this reliable measurement will be the fair value, where the fair value becomes the deemed cost of the item or items that have been contributed. Again, that might sound straightforward, but to determine the fair value, an NPO needs to know the date that it took control of each item and be able to find an estimate at that value date. As I said, if an MPO cannot obtain a reliable measurement, it cannot recognise the item as an asset or piece of inventory in its balance sheet, or at least it can't do that until it's able to get such a measurement. It can also be difficult to reliably measure services in kind, such as trying to assign a value to volunteers' time. Volunteers who donate their time for general activities that don't require specific qualifications or skills may be particularly difficult to measure. It might be difficult to capture the number of hours that they've contributed, as well as estimating the value of that contribution. Specific activities related to professional services may be easier to capture and get a reliable measurement, but we'll come back to that shortly. So practically, it may be difficult to obtain a reliable measurement because of the nature of the in-kind item. As in determining control, the costs of obtaining a reliable measurement may be disproportionate to its value and outweigh the benefits that measurement will provide. Some kind of contributions in kind form part of inventory, like the emergency items that were mentioned in the video by Philip earlier. Where such contributions can be reliably measured, you would normally see them as assets in the balance sheet, initially measured at cost. But if a reliable measurement can't be obtained, then no asset is recognised. This means that neither the revenue nor the asset will be recorded at the point of receipt. It also means that when inventory is used, this may not be recorded in the financial statements either. Again, we'll come back to this. So a lack of reliable measurement may mean that inventory items are not transparent in the financial statements. So we just talk about kind of inventory for a short period. So where an NPO acquires inventory by purchasing the inventory itself, the cost of the inventory will be straightforward to determine because you know how much you paid for it. And while there may be challenges for some NPOs in determining the cost of producing inventory that it's done for itself, these issues are unlikely to be unique to NPOs and similar to other types of organisation, whether they be in the private or public sector. But while there are no issues that are unique to NPOs for purchased inventory, there are issues for low value, high volume inventory and inventory held for onward distribution. For low value, high volume items, particularly those given for resale, such as items donated to raise funds that are sold through a shop, it may be impractical for an NPO to determine a reliable estimate. For these types of items, NPOs may not have suitable inventory recording or management systems to capture all of the items that have been donated. And if it's impractical to determine a reliable estimate of their value, then, as I've said before, no revenue would be recognised at the point that the donated items have been received. However, revenue could be recognised at a later point, most likely when the items are sold, because you then know the value of them. So rather than revenue being recognised when the gift is received, it will be recognised when the gift is sold on. So a slightly later point of recognition. But looking at sort of other types of inventory, it might be difficult to prepare a reliable estimate for items received for onward distribution. And this might be the case even if the value of each item is known. Now that might sound strange, but some items may have a value when donated, but have a zero value if they can't be used by the NPO. So for example, if an NPO receives a gift of vaccinations, if those vaccinations have to be consumed within a defined period because of an expiry date, and the NPO is not certain whether those vaccinations can be used, perhaps because it's a really short time window, it won't know whether those donated vaccinations have a value or not. And this is a real practical difficulty that can arise in determining the value to ascribe, because you just don't know what proportion of the contribution contributed items are going to have of use. So if the value of individual items is known, revenue and a corresponding expense could be recognised when the item of inventory is used. And this will provide useful information about the cost of an NPO's activities. However, if the item that's been contributed doesn't generate any proceeds, it's possible that as well as not recognising revenue on receipt of the donated item, revenue might not also be recognised subsequently because it doesn't have a sale value. So this means that donated inventory that cannot be reliably measured might not appear anywhere in the financial statements. And as a consequence, it's possible that revenue is never recognised for items received for onward distribution. And if you were to be transparent, then disclosures would be needed to show this. I've already said a bit about volunteering, but I just wanted to come back to this and just pick up a couple of points in a bit more detail. So volunteering can take multiple forms. It can be general activities like digging holes for the planting of trees, or spending time with the elderly or vulnerable to provide them with companionships. Alternatively, it can be professional services where a specific skill is being utilised, such as an architect, a doctor, accountant, engineer, or teacher, just to name a few of the potential professions. Quite often, this volunteer time would have been paid for if a volunteer hadn't donated their time in providing support to a programme or service. And this can raise questions. Services in kind can also be provided for the construction of assets. For example, an architect could be used to design a building. If this service was being provided under a fee arrangement, the cost of services would be known and included in the cost of the asset. So where assets are being constructed, the value of the services in kind should arguably also be included in the full cost of the asset, so that that is understood and is comparable with other assets held by the NPO or similar kinds of organisations. Volunteers may provide their time under the direction of an NPO. Others might provide their time independently or semi-independently. And if volunteers are providing time under direction of an NPO, the NPO may have records that capture the amount of donated time, who provided it, when they provided it, and what they were doing. However, other volunteering activities may be less easily captured. So as noted earlier on in this webinar, keeping records may present a real challenge for NPOs. Given the nature of volunteering services, NPOs that receive this kind of services in kind will recognise revenue for it, but usually consume the benefits of those services straight away. And this would lead to an expense and a revenue being recognised where the services are received. And this reflects that the service being donated and the use of the service being provided. So if I was providing my services as an accountant to an NPO free of charge, the NPO would recognise as a revenue the donation of my time, and at the same time would show an expense to show what that donation had been spent on, probably financial consultancy or something like that. But the key point is that revenue and associated consumption of the contribution can only be recorded if the information has been captured and can be reliably measured. So let's move on to another aspect of recognition around timing, which we saw earlier is a key issue for people. And it can be a challenge to decide in which financial reporting period revenue should be recognised, because some contributions and grants come with stipulations. Stipulations might be a condition that has to be satisfied, or a restriction that limits how the resources can be used by the NPO. So we're going to look at each of those in turn. Conditions can be set by the individual or organisation that is contributing or granting the cash or resource. And we heard about some of these earlier, like the hospital beds for non-paying patients in India. Government grants are provided only on the basis that this facility is made available. So setting conditions means that certain activities must be performed before the NPO is entitled to the resource. And that is the case whether it is a contribution or a grant. It makes no difference. Contributions are likely to be reflected in some form of agreement or documentation that sets out the arrangements between the contributor and the NPO. And since the NPO is only entitled to the revenue once conditions have been met, revenue can only be recognised once any substantive performance requirements have been satisfied. And when we talk about substantive performance requirements, these are the requirements that are most important and central to the arrangement between the NPO and the contributor. Judgment may be required to determine whether performance requirements have been met. And if they have not been met, revenue may need to be deferred until they are. The substance of the conditions imposed need to be considered, not just their legal form or the form in the agreement. That means that the intention or the purpose of the conditions need to be understood from the agreement. And this means that identifying the performance requirements or conditions and determining how they affect the recognition of the NPO's revenue can be a real challenge. Judgment may be needed about the chances of having to refund revenue if conditions are not met. And judgments may need to be made about whether there is a likelihood of giving a refund, and that is whether it is more likely than not that needs to happen. And of course, that assessment may change over time. These judgments need to be quantified to determine whether there's a liability arising from arrangements, and if so, the value of the liability. The liability would represent an NPO's obligation to undertake the activities necessary to meet the conditions if the stipulation specifies a return of equal value or to return the resources to the contributor or grantor. In some instances, contributions or grants are paid in arrears, with the cash transfer only falling due once conditions have been met, either in part or in full. So NPOs need to determine how much revenue to recognise in this situation. NPOs with an expected entitlement will need to determine the amount of revenue to recognise with a corresponding debtor for amounts that they're yet to receive. And again, judgments may need to be required about the extent to which the conditions attached to the agreement have been met. In addition to conditions, NPOs can receive contributions with restrictions. As I said, this is a different kind of stipulation. A restriction requires that a contribution or a grant is applied to a specific purpose. And this purpose might be operational in nature. For example, the restriction may require that the contribution can only be applied to educational purposes, or it could be for a new asset. For example, the contribution can only be spent on building a new hospital ward, for example. So restrictions set out how resources can be applied at a more general level to specific conditions that are another kind of stipulation. So guidance might be required on materiality, as well as considering costs against the benefits of tracking contributions with stipulations attached to it. So that's a really real issue here. I mentioned assets under construction earlier, but stipulations attached to cash given for the construction of assets can raise specific financial reporting challenges too, particularly if the capital asset is only to be used for a specific purpose. The requirement to use a capital asset as intended may be for a set period, or it might be open-ended. The terms in these types of arrangement may be considered a performance requirement, in other words, a condition on the use of the asset, with revenue deferred until the risk of repayment has reduced. Alternatively, it could be considered a restriction on the use of the asset with revenue recognised immediately. But of course, under that scenario, any subsequent change in use would potentially trigger a repayment as a separate event. If asset use restriction is considered a performance requirement, there may also be a challenge in understanding when a condition is met. Would it be over the period that the asset is constructed or acquired, or over the lifetime of the asset? There's some really complex things to consider here. So we've kind of looked at control and recognition, and we have touched on reliable measurement, but I kind of want to turn more specifically now to look at measurement. So measuring services or assets that are gifted, for the reasons we've said, can be problematic. Assigning a value is generally less of an issue for cash transfers, but can be challenging, as we've said, where donation take the form of gifts or services in kind. There are more significant challenges in measuring the cost of donated items, as there is no purchase cost. Instead, the fair value of the items is used as their deemed cost when they're being recognised. And we discussed earlier some of the issues in the context of reliable measurement, particularly for inventory. But determining the value of donated capital assets, tangible assets and intangible assets may be equally challenging and impact the amount of revenue recognised. For example, if housing is donated to an NPO for social purposes, it could be sold for a higher price as a commercial development, potentially. And if that is the case, it might be argued that social housing that's provided is measured to reflect its value as commercial development land. But this might not appropriately reflect the social nature of the NPO's objectives or the service potential that it might obtain from the asset. So there are different things driving the decisions here. And we discussed earlier some of the challenges relating to volunteer time. In the example that I gave earlier about voluntary contribution of my time and how that was measured, I raised that. But in terms of creating that measurement, for example, should it be measured using the rate that I earn in the market that I operate? Should it be measured by the rate that NPOs generally pay in my jurisdiction? Should it be measured at a rate paid in the jurisdiction where I'm providing the services, or some other benchmark? So the ability to measure services provided could be impacted by knowing what value to be placed on the time being provided. Services provided on a commercial basis may be more easily measured than other services, as market prices might exist. But where a service would have been purchased if it hadn't been donated, again, it might be more easily measured. And I think there is also a stronger argument for recognition. So assessing the fair value of the items may impose costs or administrative burdens on some NPOs, with the cost of assessing fair value potentially disproportionate to the value of the item and exceed the benefit derived from being able to recognise it. We've discussed the challenges of keeping appropriate inventory records earlier, particularly if an NPO doesn't have an inventory control system. So there are a few things there to consider. But after an asset has been initially received, its value might change, and there is a need to subsequently measure it. Determining subsequent values for types of inventory, whether this value derives from sales or distribution or use of that asset, it still might be challenging. Under international accounting frameworks, inventory is subsequently measured to ensure that its carrying value does not exceed the value that can be attained from the inventory. If the contribution of inventory items was not initially recognised as in the balance sheet, then there are no issues with subsequent measure because the inventory item wasn't initially recorded. But it's still important to monitor those items. In looking at subsequent measurement, inventory will need to be written down, in other words, impaired, where the carrying amount of the inventory exceeds its value to the NPO. impairing inventory relies on being able to value, being able to determine the value to the NPO. And this could be a financial reporting challenge to both determine and evidence value, particularly when considering the value to the NPO of the inventory in service delivery rather than have something for sale. There's also the question of whether and how to account for donations that are not suitable for a sale. If these have been recognised as inventory, it may be necessary to impair them if it's subsequently determined that they can't be sold or used by the NPO. And finally, to disclosure, categorisation of revenue is important, particularly if there are different accounting treatments for different types of revenue. Standardising the presentation of revenue in financial statements can assist in understanding the sources of funding for an NPO, because as we've just discussed, not all revenue can be freely deployed by the NPO. It's got some stipulation attached to it. And so it would be helpful, for example, or useful to identify revenue that has been recognised immediately, but is subject to restrictions. Stakeholders might benefit from increased standardization to access the information they need to understand the extent that revenue can be generally used to fund an NPO's expenditure. Additional disclosures may also provide transparency to present an accurate picture of an NPO's financial position and dependencies. For an example, an NPO could be highly dependent on volunteers to deliver its services. Disclosures about material amounts or activities fundamental to the operations of the NPO, like volunteer time, could be really useful. And it would provide users with visibility of the nature, amount, and timing of those. And also, it could also provide information about the uncertainty of revenue, as well as items that haven't yet been recognised in the financial statements. All of this could aid understanding for stakeholders. So far in this webinar, we've been talking exclusively about non-exchange transactions, as we described at the very beginning. In practice, there may be transactions that are partly exchange and partly non-exchange. In the consultation paper, we are only considering non-exchange revenue, but I think there is a need to identify the exchange and non-exchange components of transactions, because they can arise from time to time. And where these do exist, allocating revenues that contain a mix of exchange and non-exchange revenues could be onerous. And just a final point, we note that additional disclosures can lead to additional cost, and the cost of preparing additional disclosures may be disproportionate to the benefits. We'll keep referring to that. And some NPOs may not have the resources to provide the information. And I'm going to pause again to open it up to sort of some Q&A. I've noticed that there's been a number of points raised in the chat as I was speaking, so apologies I've not been able to kind of look at those as I've been talking to you. But it would be good to get any key points out that people would like to share. So particularly around, any additional comments or really things that you want to share on the financial reporting challenges, and also any thoughts that you have on the poll responses. Was there anything there that surprised you in any way, shape or form, or is that pretty much as you would have expected?
Okay, thanks. Yeah, sorry, I couldn't unmute. Yes, I guess in my situation, we are applying IFRS 15 in a not-for-profit environment. So we have got some additional guidance in sort of explaining what a customer is and a contract is for IFRS 15. So our biggest problem is still matching. So IFRS 15 has not solved the problem with performance obligations.
Yeah.
And I think I put in there that I think the International Public Sector Accounting Standards Board approach with their present obligation is a better approach. I don't think it solves the problem in trying to work out restrictions and conditions, but the general approach they had of, if you've got money to spend on specific projects or allowable expenditure, and essentially if you don't spend the money on what you're supposed to do, you've got to give the money back, that to me gets you to a sort of like a liability and starts to get into a closer matching of things.
Yeah.
And we have a lot of problems with capital grants.
Yeah.
In arrears, in advance. Some of those capital grants are very poorly worded. So one of the references was to IFRS for SMEs, and that talks about, well, when you get relieved from your obligation for any refund, you get to recognise the revenue. But if the grant is poorly worded to say, if you don't use the capital asset like the school building for the life, you have to return all the money, then that's a problem. Not all grant agreements are written with a sort of like a time value declining, because it's always assumed you'll use the building as you promised you.
Absolutely. No. That's some really good points there, which I think we'll probably come back to. I think, thank you very much for that, David, that contribution. I think Pesh is trying to come in, but can't unmute himself. Perhaps whilst we're trying to resolve that, are you in, Pesh?
Oh, I don't know. Can you hear me?
You are. I can hear you.
Excellent. Thank you. The issue for me on restrictions, and there was quite a lot of confusion about this over the years, is this idea that if you have to return the money, if you don't spend it, you shouldn't recognize it. Seems to me somewhat challenging, because almost every grant agreement that I have seen says that if you don't spend the money, you have to return it. So the basis that we've been using with in the UK is simply what's in the financial reporting standards and in FRS is that you work on what you expect. If you expect to be able to meet the restriction, then you would recognize the income. If for some reason you are unable to meet the restriction, then you would defer the income and create a liability. So if, for example, you had to pull out of a country, if you had a geographical restriction to work in South Sudan and you had to pull out of South Sudan, and you therefore that meant you were going to return the income, then you would recognize it as a liability. But simply because there was a clause in the grant agreement that says you might have to return the income if you don't spend it, wouldn't be sufficient to defer the recognition.
Yeah, I think there is also kind of linked to that the situation where if you're dealing with the same donor repeatedly, and the custom and practice is that even though they say they want the money back, they don't ever ask for the money back. You gets into judgments in terms of substance over form if they just kind of say, well, I know we said that, but keep it anyway. So this can be kind of really kind of complicated.
But Karen, isn't that quite normal in any accounting judgment? You would have to take a call to see whether that income is likely to stay with you, or there's likely to be economic benefit passed back to the donor. And only if you think that that's likely to happen, the same way as a bad debt provision or something of that kind, only then would you work on that basis. You wouldn't just go by what's in the document.
No, absolutely. Substance over form is, a recognized approach to this, as you say, and it needs to kind of feed into these kinds of issues as well. Pesh, thank you for that. I think Nishit wanted to come in.
Yes, thank you so much. I have 4 items with which we've had issues in the past. One is that, we are a behavior change, an organization that uses social and behavior change communication methods to enhance the value interventions. So when we do a program, for example, an anti-littering program, you would do it across many hundred schools. You would then, from the budget allotted to us, we would, develop materials like T-shirts, for example, for school children, or metal pins that school children will wear relating to the message on anti-littering. Now, the issue is that when we estimate the number of these items required, inevitably there'll be some leftover at the end of the program. So how does one account for this leftover items or inventory of material used for one campaign? The grant agreements don't have any, any kind of comments mentioned on this. So suppose, for example, we were to say, let us sell it as junk for people who recycle the material, then how does one account for it? So that's one issue. The other is about asset ownership. Asset ownership is a very tricky thing. If a grant comes to us and part of that grant allows us to buy laptops for people who are on the field, for example, then the ownership of the laptop is an issue. This is always an issue about who will claim depreciation on the ownership. Now, the recent Foreign Contribution Regulation Act amendment in India says that if a foreign donor donates money to an Indian non-profit organization, then that asset will eventually vest with the government. Now, this is a big issue for everybody here. I mean, that asset could be, it could be an ambulance, it could be computers, it could be a variety of things. So there's no clarity on how to handle that. There are other things, there are two other issues. One is about during disaster. Recently, we had the second wave of pandemic in India, the first wave last year, and lots of migrant labor returned to across from major cities across the country back to their homes. Many of them had difficulty transport, food, day-to-day shelters. So there was lots of contribution that came in from the general public, used clothes, used blankets, food parcels, and so on. Accounting for these and also accounting for the beneficiaries, because they're handed out on highways, they're handed out at railway stations. Getting details about the beneficiary with even an identification paper is very, very difficult. Therefore, that's a real issue. Lastly, one simple item: when used items are donated, a used computer, a furniture that has been used in a company and handed out, how does one account for that? Thank you.
Thank you very much, Nisha. I think that you've highlighted there some of the really difficult types of issues that we kind of need to grapple with as part of this. So really interesting. I think, Joanna, you wanted to come in to the conversation.
Yes, so I just wanted to say two things. Firstly, is to the last speaker and the point about record keeping and some of the environments in which international organisations work and their capacity to collect data. It seems nice and straightforward when you're sitting in other parts of the world, but it's not always as easy as it seems on the ground. And my main plea through all of this is to try and keep whatever solutions we come to as practical and as simple as possible.
Yeah, no, great, thank you.
The conversation earlier about having to hand the money back.
Yeah.
It is in all the contracts, and sometimes when the contract comes to an end, there are disallowables, as they're known, but they are very, very small element, and it's very rare for big chunks of money to go back to donors. So I think a simplifying assumption in that area that would say, nearly all the time, what you expect to happen is what happens, unless, as Pesh says, something extraordinary happens and you have to pull out or whatever. Again, to try and just keep it really simple, because judgments at minute levels of detail with data that's not very secure is just hiding to nothing.
Yeah, no, absolutely. Thank you for that, Jenna. Really, really helpful. I see Monica's asked a question about grants over several years, and do you recognise the whole amount? And if you think you will spend it, or just what you are entitled to in each year. I think it very much depends on what it is and the nature of the agreement. If you've just been given an amount of cash, you control that cash, then you would recognise the revenue all at once. And I think that's what we hear gives rise to challenges for people, because the money might not be spent for many years to come. So great question that's come in there. A comment from Tejas: weighting of the issues will change per jurisdiction. So it might happen that the guidance will have to address all of the options on the poll, irrespective of the percentage of interest. Absolutely spot on, Tejas. We're running this webinar in different time zones, and I think we've had a different perspective based on the jurisdictions that have attended. So we absolutely can't ignore anything, but it is kind of useful to get a bit of a steer on the things that are of interest to people, so we can make sure that we don't overlook those. Comment here about the issue of scale and size of organisation. More local NPOs may focus on volunteers, whereas larger NPOs may focus on donations in kind. Yes, absolutely. I think that one of the messages that have come through loud and clear, both through these webinars and the outreach that we did on part one, is about the need for simplicity, and particularly making sure that for smaller organizations that we've got something that they can implement. But you're absolutely right. I think the types of issue are going to vary by the type of NPO and also by the size of it, and we kind of need to cater for all of those. We've got a question here on the treatment of an asset given to an NPO with a condition to use for a specific time and give it back. More clarity on the accounting treatment. Henry, I'm going to take from that that's something that you're concerned with, and I think we're flagging it. I think we do see that as an issue, and I think when we get to developing the draft guidance, we'll be looking to provide an answer to those questions, because at this point we haven't decided how we're going to move forward in resolving the issues. So this is very much about exploring them at this point in time. Question about do NPOs have an issue around expensive of stock in a limited time frame for donor grants? Is there a practice to expense when purchased rather than being used from the balance sheet? I haven't heard that specifically. It's been much more about the ability to value the inventory. So if you have any examples of that or know anyone who has, please do put them in touch with us, because we'd be keen to understand that. One of the questions that came up in a webinar earlier today was about the methodology for issuing inventory. So FIFO and weighted average are the methods that are allowed. But the point was made that if you have got stock that is time limited, you might actually prefer to issue it based on how soon the stock is going to expire, and that isn't specifically covered. So some really interesting things there for us to think about. Tejas, a question about how to handle the differences in reporting when the legal framework of a jurisdiction has specific requirement on recognition and disclosure, which may or may not be the same as suggested by the guidance. I mean, the guidance that we're looking to develop, we want to be internationally applicable and to be applied as widely as possible. But in adopting the guidance, that is going to be a decision for each jurisdiction. And how it does that is going to need to take account of the legal framework that's there. So I think that's something that will need to be reconciled as each jurisdiction looks at how it takes up the guidance that's there. Another question, hopefully Tejas, that answered the question you raised. So for your organisation concern worldwide, we expense stock on purchase rather than carrying it on balance sheet. And that allows us to charge large donors within grant deadlines. Larger donors expect it, and generally we have to provide stock reports at the end. That is really useful. If we can follow up with you on that, Shane, that would be great. I'd like to know a bit more about that example. So thank you very much for raising it. So some great questions there. I'm aware that I haven't given you kind of a whole range of answers, but this is kind of where we are in terms of the exploratory phase for this, and making sure that we've got the financial reporting challenges properly set out. Before we move on to the alternatives, I wanted to briefly talk you through the hybrid model for the development of the guidance that's set out in part 1 of the consultation paper. Some of you may have seen this before as part of regional roundtables, but even if so, hopefully it's a useful reminder. The proposed model uses existing international frameworks with support from national frameworks. In this model, IFRS for SMEs is proposed to be the foundational international framework for the guidance. And this is because IFRS for SMEs is a single standalone set of guidance that is periodically rather than continuously updated, and therefore could form a stable base for the guidance. But IFRS for SMEs, with its focus on private sector transactions, doesn't address NPO specific issues, as we're aware. So we're proposing that full IFRS suite of standards and the full IPSAS suite of standards and their conceptual frameworks would also be used where IFRS for SMEs doesn't address an NPO specific issue. And we're also proposing that the model draws on jurisdictional level guidance to develop, again, NPO specific reporting solutions, which could include disclosures. As you may know, a number of countries have NPO specific guidance that have well thought through approaches to NPO specific transactions. But depending on the country context, this can lead to different solutions depending on which country you're in. So by adopting this model that uses all of the guidance that's available out there, we think that we can build in the most appropriate elements of existing guidance without having to start from scratch. And the alternatives that we will discuss shortly utilize this model to varying degrees, but not all follow it. Because obviously we're still seeking feedback on the model as part of the consultation paper, so we don't assume that that's where we're going to land, and that there are alternative approaches that could be taken. So let's move to look at kind of the existing guidance that's there before getting into what that means for the alternative. So the issue paper 3, which we're going to look at first, has 4 alternatives on the treatment of non-exchange revenue. And these are based on different international frameworks. Currently, international guidance on the recognition and measurement of non-exchange revenue is mainly in the following standards. First is IAS 20 in the IFRS suite of standards that covers the accounting for government grants and disclosure of government assistance. In sections 23 and 24 of the IFRS for SMEs standard, and there is a specific standard in the IPSAS suite of standards, IPSAS 23, that covers revenue from non-exchange transactions, much of which we've been talking about already. Before we get into that, I just wanted to make you aware that the International Accounting Standards Board has initiated a program to review IFRS for SME standard, and in particular to consider updates for standard issues since it was last updated. And that might impact on the current guidance that exists. And similarly, IBSASB is consulting on proposed changes to its revenue standards and has issued 2 exposure drafts, ED70 and ED71, that look at this. So those are just points to note. But generally, the guidance provided by the international standards is based on the core principle that revenue is recognised when it is probable that the entity will receive economic benefits associated with the transaction and that it can be reliably estimated. The guidance also requires that the entity has control of over the assets, and those are many of the things that we were talking about earlier. All of these standards require that initial measurement of revenue to be based on fair value at date of acquisition, and fair value may be ascertained by reference to an active market or by appraisal. The standards require a minimum presentation of incoming resources, with further disclosures, including disaggregation of significant balances being a requirement. And for non-exchange transactions in Ipsos, this goes to the nature and type of those transactions. So if we kind of look at some of the specifics that are there, within IFRS, IAS 20 provides guidance on the accounting of revenue from government grants. It doesn't specifically cover other types of non-exchange revenue. And on government grants, the standard provides that revenue is recognised on a systematic basis over the period that the entity recognises as expenses the related costs that the grants are intended to compensate. You might think that's relevant to the question that Monica asked earlier. So IAS 20 allows grant revenue, also allows grant revenue provided for capital assets to be recognised over the life of the asset by deferring in the statement of financial position or by deducting the grant when determining the carrying amount of the asset. So IAS 20 very much focused on government grants. The IFRS for SMEs standard also only addresses the treatment of government grants. Unlike IAS 20, the IFRS for SME standard requires that a grant that imposes specified future performance requirements is only recognised as revenue as or when those performance requirements are met. So the IFRS for SME standard is much more positioned in terms of thinking about performance requirements. There is no option to deduct the grant when determining the carrying amount of the asset, and this is a key difference to IFRS. The recognition criteria and measurement bases in the IFRS conceptual framework and the recognition criteria and measurement basis in the IFRS for SME standards could potentially be applied to other non-exchange revenue. Applying these concepts would in both cases result in revenue and an asset being recognised at fair value when an NPO controls a donated item. If a condition gives rise to a present obligation for an NPO, a liability may be recognised until the obligation has been satisfied. At that point, the liability would be de-recognised and the revenue recognised. So there is kind of a by analogy type approach possible there. Ipsos 23 is a standard specifically for non-exchange transactions, which it describes as those transactions where the entity receives value without directly giving approximately equal value in exchange. And that applies to cash transfers as well as other resources. The standard defines conditions and restrictions, which form stipulations. And under Ipsos 23, conditions include the situation where the entity is required to return resources to the contributor where conditions are not met. And they call this a use or return requirement. Where conditions are attached, a liability is recognised being the present obligation that arises because of the conditions. In contrast, restrictions are stipulations that are stipulations that do not have a use or return requirement, and so no liability is recognised and revenue is recognised immediately. I mentioned ED 70 and 71, and so IFSASB has recently issued these exposure drafts that have proposals for non-exchange revenue. And in the exposure drafts, revenue would be recognised when conditions are met. So where cash is received in advance of conditions being satisfied, a liability is recognised until the conditions are met. Where conditions are satisfied before the cash is received, an asset is recognised. Unlike Ipsos 23, these proposals do not have a requirement for a use or return requirement before revenue is deferred, so there are some slight changes coming through this. The other thing to mention is that the IFSASB proposals explicitly address cash transfers to acquire or construct a capital asset. It proposes that revenue from such cash transfers would be recognised as the asset is either produced or constructed and not over the useful life of the asset. Just returning to IPSAS 23 itself at the moment, it specifically addresses services in kind, which the IFRS suites of standards don't. Entities are permitted but not required to recognise revenue from services in kind. Entities are encouraged to disclose the nature and type of major classes of service in kind received, including those that aren't recognised. And finally, just to touch on national standards, which in terms of the standards we've looked at have been variously converged on either IFRS, full suite of standards, IFRS for SMEs or IPSAS, or they have been set independently of these international standards. And jurisdictions may permit or require exceptions to the general recognition and measurement requirements for revenue, primarily in respect of gifts in kind and services in kind. National standards include a number of provisions not included in the various international standards, specifically in respect of non-exchange revenue. And so while the provisions in each set of national standards are different, some of the approaches include where items are donated for resale and are impractical to measure, allowing for revenue to be recognised when the items are sold rather than when they're received. They include provisions about addressing donated items for distribution, where they look at where a reliable measurement on receipt is impractical, either allowing that a revenue and expense is recognised when the item is distributed, or there's another approach that says no revenue or expenditure is recognised for these items. So quite different approaches there. There are also some different approaches to service in kind. One is that they're only recognised where they would otherwise have been purchased. Another approach is that services in kind are only recognised when they can be reliably measured, but if they can't be reliably measured, then they're disclosed instead. And just kind of generally on as an alternative approach for donated items of any sort, there is an approach that they are only recognised where they can be reliably measured and would otherwise have been purchased. So some nuances there that are reflected in national standards. So with this backcloth, the four alternatives access both the international and national approaches. And I'll now look at going through each of these in turn. So alternative one is based on IFRS for SMEs. And it requires that all non-exchange revenue be recognised in accordance with that standard. And as we've discussed earlier, the framework provides specific guidance on government grants, but not for other kinds of non-exchange. So there would need to be some kind of by analogy type approach. Under IFRS for SMEs, government grants are recognised as revenue as or when conditions are satisfied. So that might mean that some revenue is deferred. And as I said, so for non-exchange revenue other than government grants, the concepts and pervasive principles in the IFRS for SME standards could be applied. Alternatively, the government grants requirements could be applied to other non-exchange revenue. So we think that this is likely to result in a similar outcome. Therefore, for grants from non-government bodies and other contributors, we think it's likely that the accounting treatment for government grants could be similar under this option. It's important to note that under this alternative, NPOs would be required to recognise revenue from services in kind and gifts in kind where they can be reliably measured. There would be no exemptions under this approach, and NPOs would need to maintain records to support the approach it's adopting. As with all of the alternatives, as you will see, we'll be looking at providing NPO specific guidance that would support the application of the standards and recommended disclosures. The second alternative is based on IFRS and requires that non-exchange revenue from government grants is recognised using the principles in IAS 20. Using this alternative, the treatment of government grants could be extended to other non-exchange revenue, which would allow for revenue to be recognised on a systematic basis over the period that the NPO recognises related costs as expenses. As with alternative 1, in applying these principles, NPOs would be required to recognise revenue from services in kind and gifts in kind where they can be reliably measured. Again, no exemptions under this alternative, and NPOs would need to maintain records to support their approach. And as with alternative 1, there would be guidance attached to this. Alternative 3 has Ipsos at its heart and would require that non-exchange revenue would be accounted for using the principles in Ipsos 23. The principles in Ipsos 23 cover the types of revenue that we've discussed so far in this webinar. Revenue is usually recognised when an NPO controls the assets, but is deferred when there are conditions. Non-exchange revenue is recognised as conditions that the performance requirements are satisfied. And as I described earlier, conditions include a use or return requirement. So consequently, all gifts in kind would be required to be recognised on receipt, subject to any conditions needed to be satisfied and being able to measure them reliably. Under Ipsos 23, NPOs are encouraged but not required to recognise services in kind. So this approach, this alternative, therefore provides the potential for an exemption to the recognition of services in kind. And again, this alternative would be supported by guidance about how to implement the standards and recommended disclosures. And finally, alternative 4, this is what I have named the bespoke alternative. This alternative is very much based on Ipsos, but proposes the inclusion of exceptions to be drawn from various national standards that we can consider to be included in NPO specific guidance. These types of exceptions could include permitting NPOs to recognise revenue from gifts in kind that are donated for resale at point of sale rather than receipt, where measuring their value is impractical, which would address the concern we've discussed before. Permit NPOs to not recognise inventory or revenue on receipt of gifts in kind for inventory donated for distribution, again, where measuring their value is impractical. And that also might assist with the issues previously identified and obviate discussions around materiality, which are likely to arise with some of the other alternatives. It might also permit NPOs to recognise revenue and expense when items are distributed or used to provide services. And also it might require additional disclosures where an NPO uses one of the permitted exceptions. So things that we could look at to simplify the application of Ipsos in this example. This alternative would also permit but not require NPOs to recognise services in kind, similar as because of the situation in Ipsos 23. And as with alternative 3, non-exchange revenue would not be recognised until performance requirements have been satisfied. So those are the 4 alternatives, and to help us in understanding the implications of these alternatives, in the consultation paper, we've set out advantages and disadvantages for each of these alternatives, and we've looked at them through 4 different lenses. We've looked at them through a technical lens, a practical lens, a stakeholder lens, and cost benefit. And what I've done here is kind of seek to summarize the relative advantages of the alternatives that are there. So from a technical perspective, the relative advantages have an advantage around similarity or compliance with an existing standard or conceptual framework. It's only alternative 3 with Ipsos that would follow a specific standard directly, because 1 and 2 have a by analogy, and similarly alternative 4 kind of uses principles but has some divergences from that. From a practical perspective, alternatives 1 and 2 assist by providing guidance to apply the concepts in IFRS and IFRS for SMEs. Alternatives 3 and 4, being based on a specific standard, kind of allow that pragmatic approach to services in kind that are not there in alternatives 1 and 2. Alternative 2 also offers what's often expressed to us as the easy to implement approaches in IAS 20, but we note now that this is quite an old standard, and we don't know what the future for that might hold. From a stakeholder perspective, the guidance can assist in providing greater consistency of application, and with alternatives 3 and 4, there would be additional disclosures that could be helpful to stakeholders, with alternative 4 providing further disclosures that may go even further to meeting stakeholder needs. Looking at the disadvantages, from a technical perspective, you can get quite different results depending on which international framework is used. And notably, the bespoke approach in alternative 4, there is a risk that it could lead to conceptual gaps depending on how far it departs from the existing frameworks. From a practical perspective, all alternatives other than alternative 4 have system implications, as information would need to be captured for recognition and measurement purposes. This disadvantage is most notable for the inventory items that we discussed earlier. And in addition, alternative 2 may have practical difficulties for NPOs in making judgments to estimate timing for recognition purposes. So whilst we had the advantage that it's kind of easy to implement, there's still more judgment that's required. From a stakeholder perspective, all of the alternatives other than alternative 4 have the disadvantage of lack of comparability due to a choice of accounting policy available in the standards. Alternatives 2 and 4 may also lead to a lack of transparency. Alternative 2 due to the ability to take a net approach, and so the gross position is obscured, and alternative 4 due to the potential for permitted exceptions, but additional disclosures could mitigate this. And finally, from a cost benefit perspective, alternatives 1, 2 and 3 could be more expensive to implement because they don't provide any exceptions for gifts in kind. And with alternative 1 and 2 potentially even more expensive to implement because they don't provide any exemptions for services in kind either. So those hopefully provide a little bit of kind of additional information about those alternatives. In the consultation paper, we've listed out a number of questions, and they are focused on whether we've got a correct description of the issues and to try and gather feedback on the alternatives that have been put forward. The first 4 questions are standard to all of the topics and are intended to help us develop the guidance. But in this topic, we're also interested in your thoughts about exceptions for the recognition of measurement of gifts in kind and services in kind. We recognise that transparency can lead to more work, but additional effort can be more than offset by the benefits, and we need to look at that trade-off. And we're also interested in practical considerations because we hear some people say that if these proposals result in more revenue being recognised, that may have implications from a tax or audit perspective. So some real things to think about. I think Pesh, you created a great segue into sort of a bit of a Q&A on at this point, just to kind of check in with everybody about whether they've got any thoughts or questions, or any thoughts about the alternatives preferred in the poll, and the reasons for this. Again, I haven't been able to keep an eye on the chat, but I don't know whether there's particular individuals who'd like to come in based on comments in the chat. And Sam, whether you would like to tee up that for me.
Well, I wanted to ask my own question before I tee up anybody else's. But obviously my experience is mostly in Africa, and I've seen many organisations that use the deferral approach for grants with restrictions, even if they don't have conditions. And it's a common interpretation of IAS20 in the not-for-profit space. So I just wanted to know, to clarify, are there any of the options or the alternatives that are being presented that include deferral of grants that have restrictions rather than conditions?
So I'm going to probably hedge my bets a little bit with IAS20, but with all of those, the grant is given for a specific purpose. So something that's given for a restriction means that you can, so if the restriction is that you can spend it on education, you can spend it on anything in education. And I would not expect that you would defer at that point. And so government grants are normally given for a purpose that means that there is a condition to be satisfied, or you're entitled to the revenue straight away because you can use it and spend it on anything, and you've got the grant, and so you've got control of the cash. So I don't think under any of them there is a real, and I would want to double check that there are no examples that aren't immediately coming to mind, but I would not expect that revenue that has been provided where there's a restriction should be deferred.
Thank you. So then I just open the floor. There's a couple of people who've put comments in the chat. David again, Joanna, Ivor. If anyone would like to come in, please raise your hand.
David, would you like to kick us off again? You can unmute yourself.
Yeah, yes, that's fine. So I was trying to work out how to do that the hand thing. Look, I've just, I think I've mentioned sort of before, we've just implemented IFRS 15 for not-for-profits, and it is hard trying to work out what this performance obligation is. So under the IFRS 15 standard, the broad approach is to recognise revenue as you provide goods and services to customers. Now that can be the person who gave you the money, or we've expanded the concept of customer to do things that the grantor who gave you the money requires you to do. So if it's to give money to third parties and do things for third parties, then that's meeting the requirements of the standard. But to try and work out what a performance obligation is, it's very hard. You know, examples, you've got $1 million, provide mental health services. That's it. So essentially under our requirements on what is sufficiently specific, you can't work out what the goods and services you actually have to provide in sufficient detail. So if you've got a number of counselling sessions, then that's sufficiently specific, but usually it's not. So that ends up as you don't have a sufficiently specific performance obligation. You don't get to recognise the liability. You have to recognise the revenue up front, which doesn't gel with people's common sense that it should be matched with the expenses, which is providing the services. Yeah. So, and I'm not involved with conditions and restrictions. They confuse me. But I thought that the International Public Sector Accounting Standards Board, on their present obligation and looking to, if you've got this specified project or allowable expenditure, even if it's for yourself, and if you meet the criteria, then you recognise the liability until you actually essentially spend the money. So it's spending the money is the obligation rather than trying to work out the specific goods or service. So I looking at where the ISB is going, sorry, the IPS ASB is going.
Yeah.
If they but you did mention capital grants. Now, my comment back on those proposals were, well, if you've got a performance obligation to use that building in a certain way, does that mean you've got a performance obligation or a present obligation under their proposals, and then you get to recognise revenue over time rather than over the construction period?
Yeah.
So that there's gaps in what they're proposing.
Yeah, and I think it's fair to say that with the IPSASB proposals, you know, they were a set of asked, which there were many comments, and they're considering that at the moment. So it's useful to know that they're thinking about these things, but we don't have any concrete proposals from them as yet. And they may very well be trying to address the questions that you've asked. But I think in many ways you've come back to kind of that timing, that matching concern that we saw raised earlier on in terms of how this works through. Sam mentioned IVAR as having a comment that we could bring in, and then I'll bring
Joanna's just raised her hand. Joanna, do you want to come in first?
Yeah. You're on mute, Joanna.
Okay, all right. So yes, just to build a bit on what David said, is that it's in his example, even if you knew that it was 1,000 consulting hours in terms of mental health, you don't have the costing system to tell you how much a consulting hour costs, and therefore how to recognise it. So you do, at a practical level, then come back to saying, well, we've spent the money, we've got people on the ground, they have been seeing people, and therefore it's probably reasonable to assume that we've met the condition, however badly defined it was, and therefore you come back to expenditure being the best proxy for working out how you're doing against each of those contracts. And the risk with that, of course, is that you end up recognising income that you're not entitled to, because it turns out that actually you've made all these assumptions potentially about the fact that there are people on the ground and they're providing mental health consultations that turn out, once you finish the grant and done all your reporting and it's been audited, that maybe you didn't provide 1,000, maybe you only provided 900, and arguments, and therefore some money needed to go back to the donor. So the risk is that you are over recognising income by using proxy, by using expenditure as your proxy.
Yeah.
And then you can look and say, well, for this organisation, their disallowables are like this. They're tiny. They're 0.5% of their grant portfolio. They might be running at $200,000 a year, whatever the number is. So, and that's a cost to unrestricted at that point. But to build a whole process around trying to understand what these performance obligations are, when donors are not clear about them, when practitioners are not necessarily clear about them, and the information provision, getting information about it is really hard. Being able to simplify it all down to say, actually, we've spent the money in line with the contract, and therefore we've met our obligations, and if we haven't, we'll sort it out afterwards.
Yeah. No, yeah, I mean, I get it. There are some real challenges in getting the information that is needed, and there are also challenges, as you say, about being specific enough in the agreements that everyone understands what's required out of that.
The risk in all of this is about over recognising income, and that cost of over recognising income is not in your restricted bit of your sofa, but it's in your unrestricted.
Yeah.
So running a level of disallowables provision against your grant portfolio at a summary level,
yeah,
much simpler for everyone whose job it is to implement on the ground.
Yeah.
You know.
Yeah, and you know, these are some of the things that would be good to get feedback on, about trading off kind of some of the pragmatics with the conceptual in here, and you know, that's going to be a tricky path for us to negotiate, but it's important for us to understand the significance of those so we can actually understand where the most sensitive points are. So thank you for that. That's really helpful. Ivar, do you want to come in? Not sure if you've unmuted yourself. We can't see.
Ivar Kunaka, do you want to come in? Can you unmute yourself?
Aha.
Ah, yes.
Excellent.
Much better. Well, thank you so much. My name is Ivor, and I'm a financial management expert in grant management for CSOs in Africa. And basically, from all the conversations and the discussions, the presentations, I've managed to pick something very interesting here. And I realized that there is some contextual issues that we have to also look at, the different levels at which these NPOs are classified, and some of the things that actually affect them quite different and unique one from the other. Just like you find in Africa, we've got international NGOs, we've got national NGOs, then we also have community-based organizations, which are actually, perhaps this is the biggest pool of NPOs. These are the organizations that are at grassroots level. So you find that some of the things that we're discussing here might affect them, some of the things might not even affect them at all. But one of the things that we managed to sort out maybe for the past 5, 6, 7 years is that we managed to separate grant management from institutional accounting, which I was just talking to Sam on, chatting with Sam on the side, and he was saying that no, there are different laws for that in the UK, but we don't have those kind of restrictions that you might have there in Africa.
Yeah.
And for that reason, some of the problems have already been solved just by separating the two. Whereas, I'll give an example, especially when it comes to classifying the incomes and so on. So the institution in itself is where probably you have your income and expenditure kind of accounting, where you have your income, expenditure, and your balance sheet, where you actually get to record even all the assets of the organization, especially those that are donated to the organization, probably at the end of a project. So the collaboration between, or the cooperation agreement between the institution and the funder would bring to life a project which is separate from the institution. And there you might use perhaps, this is where you find your restricted funding, grants that come, that are restricted maybe to certain contracts, to budget lines and to timelines. So separating these two, I think it solved a lot of the problems that we might be having now, using payments and receipts and payments on one side of grant management, then income and expenditure for the institutional account, which are audited separately. Yes. So you'd be treating like maybe the grants, the grants or the projects, would be treating them like something that is like a project that is being run by the institution as a service, to maybe perhaps in collaboration with the funder to achieve whatever goals that needs to be achieved. So you find that every the issue of assets, even the reevaluation or valuation of assets, which is done probably at the end when you're winding up the project itself, and the auditor verifying that, and then whether a decision is made to donate it now to the institution with the value stated and so on, then disclosure to that. That's how we solve some of these problems. So we're talking on the side about the harmonization, the problems that might come with harmonization or consolidating the grants and the institutional accounts.
Ivor, thank you very much for sharing those experiences, and I think it would be useful, already talking to Sam, but to have some follow-up conversations around that. It'd be really useful to hear that. Thank you very much.
But I think from my point of view, the comments and issues that you all raised are very relevant. I work with the Australian Red Cross. I think there's a balance that's needed between trying to get the accounting perfect and transparent, the practicality, and actually the usefulness, because we could spend a lot of resources trying to get volunteer, because we've looked into this as well, so a lot of resources trying to get volunteering data and hours and into financial accounts, but how much value does that really add when the value of a volunteer might actually be, less loneliness or social connection for that volunteer as opposed to a financial dollar, or it might be opening up skills, abilities that enable that person to get a job. So they're quite intangible, non-financial benefits to in that example, and there's probably, and there's many. So I think, so I was the person that put, I think there might be a better solution, which is outside of the financial statement. So like complementary qualitative information, as opposed to trying to get the accounting perfect. So I think if we think about who uses our statements, financial statements, people are generally more interested in the stories and the message than understanding whether we've captured, all of the inventory that people donate or not. So I kind of really feel that we need to balance that look at it more qualitatively than quantitatively, and that's why I think there might be a better solution.
Okay. So were you were the one who put forward the alternative? Is that what you were saying?
I was saying I think there might be a different sort of, because all those 4 solutions are really not that different from each other. They've got subtle differences that try and address some of the issues, but I think the best solution might actually be something quite different, where you're looking at it from not just a qualified accountant point of view, but also bringing in some other, other ways of looking at information and data.
I mean, that's really interesting. So I think in alternative 4, where we're suggesting that there might be exemptions for certain things, and using kind of disclosure as a way of filling the gaps where there's no kind of accounting valuation on things, probably is the closest to that. But I think what you're suggesting is kind of there's a spectrum of that, and actually you think there might be a point that is kind of further away from the financial in alternative, in perhaps a variant on alternative 4.
And actually thinking about what users actually want. So are they more interested in getting that extra layer and level of financial information, or are we better getting not-for-profit or for-purpose organisations to put that resource into explaining better the social impact of the work that they do? And I kind of very strongly feel that second space is where we actually need to invest more of our time and resources into, because if we can't articulate the impact of what we do, then it's really hard to, convince funders or employees or volunteers why they should actually be doing this work to start with. And I think that's like a bigger gap than some of the financial issues that we're looking at here, which are worth exploring. But when you look at the cost benefit, that's where I think there's a complementary focus that's needed.
And do you think that varies with the size of NPO?
Well, I think it could, in that if it's a larger NPO, like Australian Red Cross runs over 400 programs, so it's actually really difficult to articulate, all of those impacts, because they can be so different. So when it's a smaller NPO, it might be easier because there might be one focus. So if it's a one focused organisation, whether it's big or small, I think that's possibly easier. But I think it's something across the industry that we can all do better.
Great, thank you very much for that, Belinda. Hi.
Regarding the general fund and special fund that you presented earlier, will it still be consistent with the fund also given by the American standard? Still consistent with that? For example, when you talk about special fund, will there be part of the special fund wherein you can use it also to other specific entity for a special purpose, for example? Because when you talk about general fund, you can use it for any purpose. But for special funds, really for this only particular project by itself, would there still be, is that consistent with the American standard regarding fund? I'm talking about general fund and special fund only.
Breaking up slightly, but I think if I've understood your first question, it's about why we're not looking at the US gap, why we're not looking at FASB. Is that correct? Is that your question? So the principle that we're adopting and is set out in part 1 of the consultation paper is to start with international standards as the start point for this. And not because that has been through a global due process that has given everyone the opportunity to kind of input to those international standards. If we picked the standards in any one jurisdiction, that wouldn't be true. And so we're starting with international standards, but I think, as we've said, we will look to access national standards. So to the extent that the US, Canada, Australia, New Zealand, UK have got their own national standards for non-profit entities, that we will look to that. So there'll be elements of the American gap that will potentially feed into this, but we want to start with international standards because of their accepted international basis. Does that explain? Yeah. Cool. Excellent. I missed the second part of your question.
May I make a question here? Regarding, so can you hear me on that?
Yes, I can. Yes, I can.
Yeah. Regarding the purpose of the fund.
Special purpose fund.
It's really for a special fund, right?
Yeah. So again, this project is focused on general purpose financial reports and statements, those that are generally applicable rather than special purpose financial statements. So so we're not looking at that. If you think that there are types of non-profit entity that have got specific requirements, it would be good to hear about those, and perhaps you can either put something in the chat or email us afterwards. But we are keeping to general purpose financial reports as part of this project.
Yeah, so that depends also on the donors, right? How about the board of trustees? The moment that they have to set aside some special fund, the board of trustees. So if they already set aside the fund.
Can I'd like to park that. So we've got another, or I deal with that offline. We've got another webinar coming up talking about financial statements presentation, which will talk about reserves. So we'll be looking at that particular issue as part of that topic. If you're not able to attend that webinar, if you just drop us a question and we'll follow that up separately.
Hello.
Hi, Gareth.
Hello. Thank you very much for this event. Very interesting and useful. I'm being a little bit provocative, but I've raised the question. Surely, if we start from the IFRS for SMEs, all the problems around fair value will still be projected onto non-profits. And as we know, there's a huge argument that the whole notion of fair value is really specific to the commercial environment and can't really be used that meaningfully in a non-profit context. You want to comment on that?
So in some ways, I would put it the other way round, in that I think there's lots of fair value stuff, particularly around financial assets and liabilities in the for-profit sector. That's commonly where it's talked about. But in the public sector, where I've got an extensive background, fair value is used pretty extensively in valuing all kinds of assets, including property, plant and equipment. So the concept of fair value is used quite broadly in organisations in the public sector that again don't have that profit motive. But it does raise questions about how fair value is determined, because the IFRS 13 is looking at the highest and best use price for things. But when you're looking at fair value in entities that aren't driven by an exit price, there's other things that need to be taken into account. So I think when we're looking at fair value in the context of organisations that don't operate for profit, I think we need different guidance to support the generation of those fair values. I don't think that it's less relevant, but it certainly needs to be looked at in a different way and to help people prepare those.
Great, then both Shane and Fernando have made comments in the chat. I don't know if either of you'd like to put up your hand or unmute and share your thoughts. Or if you're feeling very shy, prefer to stay in the chat. That's also okay.
Yeah.
Maybe you can you see in the chat, Karen? Maybe
I've got Fernando's question in front of me. He may have come in last, so apologies, but I'll just pick up on that. I mean, there's been a lot of discussion about whether IFRS and IFRS for SMEs should be the right start point for non-profit guidance because it's generated from for-profits. And if in part one to the consultation paper, we've done quite a bit of analysis around this to kind of look at the pros and cons of the different international frameworks. And I think we recognise that there are clearly issues with IFRS for SMEs. It does not provide a complete solution, but it has lots of advantages for non-profit organisations in being easier to take on board because of the size of the standard and the way in which it's updated. But I think, as I set out in the hybrid model, it clearly isn't an answer on its own. The other point that I would make as well around that is in the public sector realm where standards have been and are being developed, the principle that they adopt is to follow IFRS as much as they can and only move away from it where there is a sector specific kind of requirement that drives a specific need. And so a lot of the IFRS guidance is captured in IPSAS standards. And I think that may well be true of non-profit organisations. Whilst there are a number of things that are specific to non-profits that need to be dealt with, there's also a lot of things that are in common as well. And so using some of the stuff that is in IFRS and IFRS for SMEs may be completely appropriate to do because that guidance is relevant, but completely acknowledge that it doesn't cover everything that is needed for NPOs, and in some cases it isn't relevant. And that's why we're doing this project, and also we're looking at an approach that doesn't rely just on one of those frameworks. I hope that goes some way to answering your question, but I know this is something where we're really interested to get people's views on and encouraging responses as part one of the consultation paper. And I should make a plug for that because part one of the consultation paper, the consultation period finishes on the 30th of July. So that's coming up fairly shortly. So if you've got views on this and how this fits together, please do use that as a mechanism to kind of share those views. But I don't think there's a silver bullet here. So I think it's about how can we kind of make the maximize the benefit of what is available.
Can I come back on the point I was raising about fair value? I mean, do you anticipate that IFR4NPO standard will require all this stuff about discounting of multi-year obligations under fair value? Because that's what's caused horrendous problems for NPOs in many places. And I appreciate there's all the argument about whether it's material or not, but often people do seem to conclude that it is just about material, and you've got a 3-year grant and you end up with a horrendous discounting calculation that nobody who's reading the financial statements then really understands.
Yeah, obviously, kind of the time value of money point is one that does come up, and I'd be really interested to get the example that you have and share that with us, because we want to come up with some guidance that's pragmatic and we can simplify it as much as possible. So if there are specific issues like that we can look at as we are building the guidance, we'd very much like to do that. Okay, so I missed a question. Who did I miss a question from? From Shane. So if we start from IFRS, does that open up the issue of being at the mercy of the ISB changes, which may or may not take NPO accounts needs into account? Clearly we're talking about IFRS for SMEs as the start point here, and that is a standard that only gets updated periodically, typically I think every 5 years, so it's not changing all of the time. And as IFRS for SMEs is updated, we would lead to input to that process. But we can also, if we felt that IFRS for SMEs was moving away from what an NPO needs, we would want to kind of update the NPO specific part of the guidance to make sure that we don't unintentionally go on a track that we don't intend to be on. So I might move us on then to look at the final issue paper around inventory held for use or distribution. And I'm going to start with the existing international guidance on the measurement of inventory held for use or distribution. And they're included in IS2 on inventories within the IFRS suite of standards, in IFRS for SMEs, section 13, and IPSAS 12 on inventories in the IPSAS suite of standard. IAS 2 and section 13 of IFRS for SMEs require inventory to be measured initially at cost and subsequently at the lower of cost and estimated selling price less cost to complete and sell. I think we frequently refer to that there as net realizable value, and I'm going to stick to that term because it's quicker for me to say. Where the cost is greater than the estimated selling price, the net realizable value, then inventory is written down to that value, and that's what's in those standards. But neither IS2 or IFRS for SME specifically addresses non-exchange inventory. However, if these frameworks were being applied to contributed inventory, then these contributions would be initially measured using fair value as a proxy for cost, and that's as a result of their general recognition requirements. IPSAS 12 has got similar requirements to the IFRS suite of standards. However, IPSAS 12 does not apply to work in progress of services that are provided at no or nominal consideration. So, for example, if an NPO was preparing legal casework to support refugees and asylum seekers, until a case is heard, the casework being developed may be considered as inventory if it meets the recognition criteria. So unless record keeping systems such as timesheets are in place, NPOs might find it difficult to determine the cost of the casework to record as its inventory. But under IPSAS 12, organisations are required to develop their own accounting policies for these kinds of transactions. And that allows organisations to expense the work as it's undertaken rather than record it as inventory. So that's kind of a bit of a dispensation there. IPSAS 12 also requires that contributed inventory is initially measured at fair value, with inventory held for use or distribution subsequently measured at the lower of cost and current replacement cost. There isn't an equivalent of this in IFRS or IFRS for SMEs. All of the frameworks provide guidance on the elements of the cost of inventory and on allocating overheads like fixed overheads and variable overheads, and they permit the use of techniques such as standard costing and other methods that are permitted to approximate cost. Where inventory is not valued individually, the frameworks require either the use of first in, first out, FIFO, or weighted average cost formulas. The last in, first out formula is not permitted under any of these international frameworks. Under all of the frameworks, the value of inventory is assessed at the end of the reporting period. And where the value of inventory is actually below its cost or initial fair value, it's written down to net realizable value in the case of IFRS and IFRS for SMEs, and to current replacement cost under IPSAS. And that amount of write down, the impairment, is recognized as an expense. Just to touch on national level guidance here, we found in the work that we've done so far that national level guidance, again, are various. They can be converged on IFRS for SMEs, IPSAS, or developed through other national frameworks. In the frameworks that we looked at, there is consistency on the core principles around accounting for inventory, but we did note differences between jurisdictions about the measurement of inventory held for use or distribution. In some jurisdictions, it is measured at the lower of cost when impaired for any loss of service potential and replacement costs. And in another jurisdiction, it's measured at the lower of cost and current replacement cost. With the work that we've done suggests that in practice, they might not have substantially different outcomes, but the loss of service potential does come out in one of these frameworks. So both international and national accounting standards adopt similar principles for accounting for inventories, and the differences between the standards relate to whether specific provisions are required for donated assets, the application of the standard to work in progress of services provided at no or minimal consideration, and the measurement of inventory that's held for use or distribution. We've used these approaches to develop the three alternatives that we have put in the consultation paper. So alternative one is based on IFRS or IFRS for SMEs. And under these standards, as I've just explained, inventory is measured at the lower of cost or net realizable value. There is no specific provisions for the measurement of donated inventory or inventory held for use or distribution. And so the main standard would need to be followed. We would provide NPO specific guidance, which would cover situations where it might be more practical for NPOs to apply general materiality principles and expense items as they're required. But there would be no divergence from the requirements of this standard. Also, the guidance would provide examples about applying the general provisions for inventory as part of that package. Alternative two is based on the requirements of IPSAS. And as I said, under this standard, inventory is measured at the lower of cost or current replacement cost. Similar to IFRS, there's no specific provisions for the measurement of donated inventory. However, the standard does provide for work in progress for work done for no or nominal consideration to be expenses incurred. As with alternative one, additional NPO specific guidance would be provided, which could cover situations where it may be more practical for NPOs to apply general materiality principles and expense items, as said before. But again, there will be no divergence from the requirements of the standards other than in relation to work in progress for note or nominal consideration. So again, additional NPO guidance would cover examples and how to apply the standards in the context that we're describing. The third alternative is based on alternative 2, with the requirements of IPSAS 12 at the heart of it, but departs in requiring that inventory for distribution is valued at the lower of cost and current service potential rather than current replacement cost. This valuation technique is not permitted by any current international standards, but is required by one jurisdiction as part of its national standards. So this alternative would require the disclosure of the calculation of the loss of service potential, including where this reduces it to 0, and kind of the significance of this inventory in meeting organisational objectives. As with alternative 2, work in progress at no or nil or nominal cost could be expenses incurred. And as with both alternative 1 and 2, additional guidance would be provided. Similar to the last issue paper, we've looked at the relative advantages and disadvantages of these alternatives. And it's clear that from a technical perspective, these differ. Alternative 1 follows or would allow the foundational framework of IFRS for SMEs to be followed. Alternative 2 provides that another international framework is followed, but not the foundational one. And it could be argued that IPSAS provides more appropriate valuation techniques. From a practical perspective, additional guidance will assist in interpreting the international frameworks and assist with complexity. And that applies to all of them. But with alternative 3, there is also the benefit that the use of an approach of adjusting for loss of service potential could be easier to determine than current replacement costs, and so that might be a real advantage. From a stakeholder perspective, alternatives 2 and 3 could aid consistency on approaches to the valuation of inventory held for use or distribution. And in addition, alternative 3 can aid the relevancy and transparency through information provided in disclosures. From a cost benefit perspective, additional guidance may aid in reducing costs by supporting cost benefit decisions and applying the relevant standards. And that's particularly the case for alternative 1. In terms of the disadvantages, from a technical perspective, alternative 2 is obviously departs from the foundational framework that we're proposing, and alternative 3 moves further away from this and from using an international framework as its base. And as I've said, it proposes a valuation technique that is not permitted by any current international standards, but it is used by one jurisdiction internationally. Each of the alternatives is left with practical challenges. Valuing donated inventory could provide challenges for all of the alternatives, which we hope the guidance will help with. But alternative 1 may have difficulty, particularly in applying materiality to transactions. For stakeholders, all of the alternatives could be impacted in varying degrees by lack of transparency, which we hope the guidance could mitigate. The option to write off work in progress in alternatives 2 and 3 could also result in inconsistency across NPOs if some choose to do it and some don't. As noted, measuring inventory might be costly and could be the most costly under alternative 1. So that's kind of a snapshot of some of the advantages and disadvantages that could be there. Again, not exhaustive, but give you an indication of some of the things to think about. As with issue paper 3, we have got a list of questions in the consultation paper. For this particular issue paper, these are the standard questions that we're asking, which is about making sure that we've understood the issue and getting feedback about the alternatives that are being proposed. As with the previous one, again, we would like to get your feedback through a poll. We'd be interested in getting your views about those 3 alternatives that I've just described. Do they feel to you to be viable ways of taking this forward, or is there an alternative approach to this? And in terms of any preference you express, why do you have the preference that you have? Any thoughts on what's there, and particularly around the alternatives? David, you have your hand up.
Okay, sorry, I'm just getting the unmute right. I think that there are 2 areas that I sort of looked at. One is Australia uses IFRS, which is essentially IFRS for SMEs, particularly for this one. So we've essentially got like 2 or 3 paragraphs that are different for not-for-profits. It essentially says, don't worry about net realizable value for inventory because you're not holding it for sale. Sometimes it's for distribution and gifting and things. So sort of essentially use it like replacement cost. So there's no sort of service potential. It's sort of linked in, but I think it's worded more replacement cost, which makes it easier. And the other one is the donated item. So there's not a lot of not-for-profits that have inventory that I see, that they're holding it for sale or distribution, but it does cause a problem. I'll use the Salvation Army. I don't know what their accounting is, but let's use it because most people can relate to it. They've got these opportunity shops where you can go in and buy things. So we've essentially given a practical expedient to essentially look at the materiality and like have a low value exemption. So if you don't want to, you don't have to essentially value donated items, but some organizations do. I can't remember which one it was, but they wanted to, and they're allowed to if they can sort of work out some sort of reliable measurement to it. So I think it works because most organisations that are dealing with thousands of items just don't have the systems. It's not needed. You've got fairly quick turnaround, or should have fairly quick turnaround. So from one year to the next, it's do you really need to get an accurate inventory?
No. Thanks, David. I saw that Joanna's put her camera on. Did you want to respond to that?
Okay, so if I could just reinforce that, because the valuing donated stock to shops, if that became a requirement for lots of charity shops in the UK, and I realise for some people this is a UK question, that that's a lot of systems for really not much benefit. And even if you were able to record the items, what value they then gave each item, well, you don't know the value to you and sell it. So you then go back, well, it's probably the best value when it's given to you is nothing.
Yeah.
If it doesn't cost you anything, if the value is nil, then that's your value. You don't have to do anything because it's nil. So and that would be a really serious overhead on charity shops if any attempt was made to try and value the donated stock.
Yeah. No, thank you for reinforcing that point. And I think we certainly see that as an issue and recognise that.
Karen, I guess with some of the sort of very evolving concerns around climate, some of the cost of wastage and removing inventory, so donated clothes that can't be sold, for example, is actually more than the value of the stock themselves, and then also brings that carbon footprint as a result of getting rid of that stock. So it's just I guess it's not really a question, it's just a voicing out loud a concern where we might be putting value onto something that actually is not a value, it's a liability.
That's a really interesting point. I think as we did the outreach on part 1 of the consultation paper, particularly when we were talking about narrative reporting, sustainability and climate change came up as part of that. And increasingly, I think in day-to-day, I think people are starting to think about those climate impacts on like the financial reporting side of things as well. So a really relevant point to make, and I think something that we'll need to consider, whether there is a climate perspective that we need to put on this that might feed into how we look at some of these items going forward. So yeah, that's a really interesting point. I'm sure it's going to come up in a number of different guises, so good to put it front of mind. Yeah. Any other points anyone wants to make on this? I think one there was somebody who was preferring IFRS for SMEs, particularly interested in whether there was sort of a really important reason for that anyone's prepared to share. And any observations on the poll responses as well, in terms of whether...
Karen, I know Mark wanted to come in. He mentioned something in the chat.
I haven't
Mark, do you want to come in and then maybe...
Sure, it's basically, to be honest, the main issue I've had with inventory has been slightly different from this, which is that, especially when dealing with perishable goods, and I'm thinking food or medical supplies, a big problem has been that using first in, first out, or weighted average, or whatever, doesn't really bear much reality sometimes to when goods need to be used.
Right.
And whether it's possible to get in something like first expired, first out, to encourage people to use goods more sensibly.
Yeah.
Whether that I think would be a really big help. Whether that's a practical option or whether I'm just putting too much into this project, I don't know.
No, it's a really good point. I think we did make the point there that sometimes donations are made of things that are close to expiry date, and if you got donations from 2 different peoples on successive dates, but one was closer to the expiry date than the other, then from a practical point of view, you want to distribute the one that's closest to expiry date first. So I completely get that. That's a really good point. No, thank you for raising that. That's really good.
Thanks.
Thank you. Ram, did you want to come in?
Yeah, thanks. I was the culprit who put up alternative 1. For me, yeah, it was a close call between 2 and 1. And I was thinking about donated goods. And I was thinking about current replacement cost for donated goods. And I couldn't quite get my head around how you do that. So that's the reason I plonked on alternative 1. But I mean, it's not always the case that inventory is donated. Quite often it can be purchased. So current replacement cost may very well be the better option. So as I said, I wasn't quite sure about whether I was going to go for 2 or 1, and I ended up choosing 1, but clearly there's a strong preference for 2.
Yeah, I think you raise a good point, and I think that may be where there is the current replacement cost and service potential debate comes in, because if you're an NPO that's relying on donated inventory to deliver your service, if for any reason that got written off because there was a flood or a fire or something, and you needed to replace that, you still got to deliver your service to it, and so you still need that inventory to do that. And so it would be interesting as we work through the technical side of this, thinking about, well, what does current replacement costs mean in that regard. And because clearly there is a loss of service potential, and that's what might make alternative 3 more attractive, because that's potentially more directly meaningful for an NPO. But yeah, so those valuations are going to be really important as we work these through. Discussing. So we're kind of in the last part of the webinar today, and it's been really great to hear your input and comments and questions as we've gone along, and it helps us, and we hope that it has helped you today, and we hope that the hearing things has given some clarity to the proposals that are in the consultation paper and kind of helped you work through your views on them. So of course the most important next step is for us to encourage you to go ahead and submit your formal response, either as an individual or if you're doing something more broadly as part of your organisation. The closing date for comments is the 24th of September, so still a bit of time to do that. But you might find it easier to respond to the questions while today's webinar is fresh in your mind. Please don't feel that if that you kind of have to answer everything. Please build up your feedback, and if this is the only area of interest that you have, please just comment on that. All the information is on the IFR4NPO website. But if there's further webinars that you're interested in that are coming up, please do look at the website for that too. So now we've taken you through those 2 topics. The consultation response, as I said, is kind of the next step. We've tried to make it as easy as possible to submit a response. And there's 3 different ways that you can share your views. You can go to the website and the information is all there. If you're an organisation who has a process for submitting comments on accounting standards, you can submit a comment letter in the way that you would normally do via our website. If you'd like to submit a response as an organisation or collaborate with others on a response or just work offline, then the second option is to download a Word template that is available on the website. You can then put in your thoughts and hold on to it, and when you're ready, upload that back to the website. The third option is great if you're submitting as an individual. It's an online survey. There's a survey there for part 2 that covers all of the things in part 2, but again, you can just answer the bits that you are interested in. And once you've put in a bit of information about who you are as a respondent, you can save it and come back to it as many times as you want until you're ready to submit. So we're really hoping that you're feeling motivated and confident to submit a response to today's topics, even if you've never done something like this before. Getting a large number of responses from all regions of the world will really add to the quality and credibility of the guidance we produce. We know that some countries already have NPO guidance, but we want to learn from people's experiences. And so it's really important that we do get a good cross-section of views come through. We want to try and sort of end on a sort of more positive note, because we've heard about issues and challenges today. That's what we've talked about. What about your hopes for the future? And the guidance offers an opportunity for a way forward, and we kind of like to hear what's in your mind around that. So we'd like to sort of get 1 or 2 words from you about your hopes for the future, and to do this we want to use a Menti poll. So if you have another device that you can use, or another window on your device that you can use, whether it be a phone, a tablet, or a laptop, if you could go into menti.com, and then we would ask you to put a code in. Paul, can you put the slide up with the code to go in for this session? Hopefully you have that there. But you can be thinking about it whilst we just get that ready. You don't need to leave the meeting. and we'd like to share with you the thoughts of this audience about what those are, and then we can talk about next steps. Paul, are you able to do that?
Yes,
We've lost Paul, which is a bit unhelpful. Here we go. Okay, so if you can use the code 41677994, you'll see that there are some words in there already. We ran a webinar very early this morning, and these are some of the words that came up from that discussion. You don't need to, don't have to use one of the words that is there, but it would be good to kind of get your thoughts if you can add some words to that. Great. Some words appearing here. Just give you a couple of minutes just to do that. Any other words? Clarity was the lead word from this morning. It still looks like it's the lead word, but closely followed by consistency and simplicity. That's there, and there's another word there, simplification. So simplicity, clarity and simplicity are shining through along with consistency. If please do keep your Menti open. I'm just going to close out the webinar, but if you want to add some more words to this, please feel free to do that. We'd like to capture your hopes going forward. So please feel free to add to that whilst that's going on. Okay, so let us just bring back the final part of the presentation. Okay, let me just up. Okay, so you might want to know what we're doing next in terms of next steps. We've talked about next steps for you in terms of responding to the consultation. But we wanted to kind of put this in the context of what we're doing. Where we are at the moment is in the outreach on the consultation phase, which has gone through the first 3 quarters of this year. The consultation phase ends for part 1 on the 30th of July, so at the end of next week, so very imminent, and for part 2 on the 24th of September. Once we've had all of those responses, then we'll start to analyze those, and we'll use those responses to then help us develop the draft guidance. Our plan is to try and keep the outreach going through 2022 so that we can kind of continue to talk to you about how we're developing the approaches for the draft guidance. So a lot to do over the coming couple of years. And finally, kind of how can you stay connected during this process, because we do want you to be connected. If you haven't done so already, please subscribe to our quarterly newsletters. That will keep you up to date and make you aware of events going on in your regions. Sam, I think, is hopefully going to post these into the chat, but we will email you afterwards with all the relevant links. Please do follow us on social media, particularly LinkedIn and Twitter, if you're active there. It's great if you're able to comment on, like, or share our posts. When you do that, they get seen by more people. That means that more voices can be heard. We're really aware of how diverse and spread the non-profit organisations are across the globe. So the more we can help people hear this, the better. You can always email the project, myself or Sam. Again, Sam will put the addresses in, but we'll send them afterwards in an email with the PowerPoint presentation as well. We'll put a recording of the webinar on the website. So you'll be able to access that going forward. And just a sort of a quick plug, if that's the right terminology, if you've got colleagues who you think will be keen to view the webinar, please do point them to it. And this is the first of 5 webinars we're holding to cover all of the topics that are in part 2 of the consultation paper. So if you're interested in any of those, please check them out on the events page on the IFR4NPO website. So that leaves me to thank you very much for your time today. It really is appreciated. I know it's a big commitment to be part of this, and we find it incredibly helpful and hope that you do too. We look forward to engaging with you as we kind of continue our journey to develop the first world internationally applicable financial reporting guidance for non-profit organizations. And again, we kind of appreciate it from Sam and myself. We're really grateful for the contributions that you've made. Sam, I don't know whether you want the last word before I wish you all
maybe just to thank you, Karen, for a marathon of a webinar and for putting all this together. Thank you so much. Thank you to all of you for your brilliant comments. Honestly, they're really valuable and important in helping us balance different views and perspectives. It's been really helpful. So see you at the next one. Thank you very much.
Thank you very much, everyone. Have a great week. Bye.